Hey investors, welcome to the February 2023 Global Markets Update from Boom Bust Invest. So we're going to cover the main drivers, indexes and indicators for our globally diversified funds. So if you have a pension, you're going to be invested in some sort of portfolio of globally diversified stocks and or a globally diversified fund like VWRL from Vanguard. So we're just looking at the main drivers for these kind of funds where a lot of our money will be invested. So we will look at like the S&P 500, but others as well, like UK, other regions, and like I say, just some of the main drivers to show where these markets or these funds might be headed. So let's start with the S&P 500 very briefly. The main thing to look at now with the S&P 500, which will be a big constituent of our funds, as I say, so we do need to sort of keep abreast of it, is the earnings. So I've got some earnings kind of information updates here, and so I'm just going to sort of briefly summarize where I think we are. So this is from FactSet, and so the Q4 earnings are subpar, described as subpar. The metrics are below their 5-year and 10-year averages. If the index reports an actual decline in earnings for Q4 2022, it will mark the first year-over-year decline in earnings reported by the index since Q3 2020, which is obviously to do with the pandemic. So not great in terms of a sort of summary for the earnings. However, again, another update from FactSet on the upside says that there are the chances of a Goldilocks soft landing, and those chances apparently are growing. But with US unemployment is at a 53-year low, which maybe needs to be taken with a pinch of salt. There's lots of accusations of the federal authorities in the US massaging these figures using accounting gimmicks, but I guess we'll take it at face value. Like if that is true, then unemployment is low, then chance of recession would also be low, and real wages turning higher throughout 2023. Also for global markets, so the ex-US developed stock markets have outpaced the US market in the last 2 months by some 20 percentage points, the biggest relative gain for the last 20 years. So global markets are in good health. From an earnings perspective, then there's conflicting information. So this one is on Isabel.net and shows the earnings breadth revisions heading down. So we can see here this was 2020, this was the Great Financial Crisis, and we're heading down into that kind of territory. So there's kind of conflicting information here. Earnings aren't necessarily very strong at the moment. But then finally, there's a graph here from Yardeni that shows the world. So again, we're interested in like the world, the global markets, world markets, heading down, maybe heading back up slightly, but in the kind of on the wrong side of zero. Once again, this is a great financial crisis, and this is the COVID crash. So we're not, the global markets are not in particularly bad shape, but heading in the wrong direction potentially. So we're not out of the woods yet, but we're not particularly in a bad state, I think. So that's earnings, which we kind of need to keep an eye on. So all of these graphs that I'll show you, and all of the links are there, so you can come along and check these out for yourself if you want to take a look at things yourself. So on the markets, then the S&P 500, I'll cover it in more detail here, but we can sort of see a classic inverse head and shoulders here. So this is the 5-year chart, S&P 500, stalled a bit currently, but if it pushes higher, then we could sort of say we've got yet another high, and then we're moving up in the right direction. Nasdaq, same kind of story, kind of inverse head and shoulders there, but pushing up in the right direction at the moment. the Dow Jones, so the more of the industrial, traditional stocks in the US. So again, that's come back up and is just sort of stalling. Japan is just sort of ranging sideways, nothing much going on there. Germany has made a full recovery almost to previous highs, as has the UK. So Europe is kind of looking pretty good in terms of that's contributing to our global funds. So it's the US which is really dragging things down at the moment, and let's cover it here in a bit more detail. So this is like a longer term chart, so we can see, like, you know, how the downturn in 2022 was like quite sharp and severe. It kind of looks worse than the great financial crisis in 2008, 2009. However, this is like sort of 50%, where this is more like sort of 25%, but it's come back up. So in terms of, like, if you like technical analysis, we kind of need to see this previous high breached here. So we need to see it pushing higher up to sort of 420 to say that we're heading for a more sort of long-term secular bull run. Until we do that, we can't really say that we're there. We're not there yet. So for me, in terms of allocating more cash to my globally diversified funds, I'm waiting for that at least to happen, at least to breach sort of 420 and sort of stay there meaningfully. So that's what we need to see on the S&P 500. That will help our global funds. In terms of the market valuation, there's a really nice, again, a link here to a really great little resource called currentmarketvaluation.com, and it's an aggregation of the sort of main valuation methodologies for it is for the S&P 500. So it's an aggregate. So currently, if we just switch to the gauge, switch to gauge and tideline, the gauge it's fairly valued, but it's heading towards overvalued. So we kind of want to invest more when it's here to here rather than beyond here. So this takes, as I said, the aggregate between the main valuation models. So the yield curve model, which says it's strongly overvalued, and then I'm not going to go into this, we're here all day. The state coincidence index model overvalued, the Buffett indicator model overvalued, price to earnings of the CAPE, cyclically adjusted price to earnings, is also overvalued. So all heading in the wrong direction in terms of valuation. Interest rate model is fairly valued, which some might say is actually the one to watch. So according to that, fairly valued, and then the final one, debt margin model, fairly valued also, and the S&P mean reversion model is overvalued. So this is the aggregate of those valuation models. So not necessarily the best time to invest in terms of the S&P 500. Another good barometer of global demand is the South Korean stock market, so the KOSPI. So this is kind of like a leading indicator. This started heading down, you see here, May, summer 2021, about 6 months before the wider market. So it's ringing the alarm bells here way before the downturn that we've just seen in 2022. That's also sort of, it's formed this classic inverse head and shoulders here, but it's struggling to breach this horizontal resistance level here, and it's got work to do to sort of move above that to show that global demand is actually returning. However, it's a higher low here rather than a lower low. If it comes down and we see it going back up into say March, April, then we can say that we've got more confidence to say that global demand is truly picking up, and that for me, that's a better sign, a better time maybe to allocate more funds to a globally diversified fund. Until then, we're kind of struggling. If we see it heading down into March and April, then we've got a continuation of the weakening of the global economy and global demand. So the KOSPI is a really good measure, which is why we'll look at it here. So as I say, if you just come to boombustinvest.com/crash, you can see the live charts here on the page. It's kind of why I call it a dashboard. The global Dow, which is the biggest 150 blue chips, is telling a different story. That is showing a good recovery with highs breaching previous highs in the downturn. So that's the big blue chips, the really big blue chips, is showing a good level of health for our funds. So that's a good sign. Obviously, you need to see that continue as well. And then the asset classes. Let's have a quick look at the BlackRock asset classes here for 2023. We can see equities, China equities on top. Other equities doing well. So our equities so far so good. REITs also doing well, and even the sort of credit and bonds at least are in positive territory, unlike 2022. So again, that's bullish. Adding to the sort of the bull case for 2023. And then there's one also from MSCI. Just take a quick look at this. So MSCI, one of the biggest global index providers. You can see it's only the world figure we're interested in here. So it's sort of about 7% year to date. So that's good. Again, it's just pushing higher. So there's no real cause for panic as yet, unless we start to see those charts go head down sort of in a sort of meaningful way. There's a great little website here, AI Outlooks, which has, I'm just going to show this breaks down the sort of country by country performance, and you see they do tend to sort of move in lockstep. And so we see the peak here, and we see the sort of the laggards here, like Brazil. But India up 40%, Brazil minus 30%, Canada 40%, Eurozone just at 14%, and currently it's in the uptrends. It's downtrend here for 2022, uptrend for 2023. Although currently it's just sagging slightly. We need to see that current trend continue up to say that we are in a more of a sort of secular long-term bull. So we're not quite there yet. We're not out of the woods. So yeah, again, that's there. If you want to take a look at that, the banking system. So the banking stocks. This is actually the European banking stocks, using that as a sort of global measure for banking, is in rude health. So again, no cause for concern in the banking sector at the moment. Finally, junk bonds, high yield corporate bonds, which tend to sort of lead the market. So we do have some conflicting information here. I mean, it is trending up with the wider market. So we see a bottoming here at sort of late 2022. We see higher lows, higher highs. Although this needs to be confirmed as a higher low. If we see, it's got some work to do really, because it needs to get above this level, which is a kind of important horizontal level. It needs to then breach this level to get 78. So it's actually got quite a lot of work to do to sort of confirm, as this is a sort of leading indicator for stocks. Then it's got quite a lot of work to do to sort of confirm that we're heading in the right direction. Typically, the bond guys get it more right, accurately forecast where things are heading than the equity guys. So it's actually got a lot of work to do to sort of confirm what we want to see to get back up here. So heading in the right direction currently, and yeah, so we need to keep an eye on that. We need to see that head back up. So that's high yield HYG junk bonds, showing us that sort of conflicting information that we still we're not out of the woods yet. We need to see these indexes and charts head up and break those previous highs, the near term previous highs, to say that we are in a proper reversal of this downtrend. We are not yet, but we'll see how that goes over the next few months. Okay, so that was just the introduction for February 2023. There'll be some other videos if you're interested, some of the main drivers like the big government bond yields, etc. So if you like this, please like and subscribe to help the channel out. and I'll see you in the next video.